So we move to chapter 25, Analysing Performance. Now we know that the performance of businesses is where accountants, whether they're management accountants or indeed financial accountants, come into their own. This is a key chapter for us, not just for the MA exam, but also for you and your career, being able to analyze a business and to look at the various heads. For example, profitability is absolutely central to your expertise. So this first section, profitability measures, is one of several, and indeed all are important. Let's take a look at profitability and what we mean by measures. Well, several sort of ratios, if you will. Now remember, profit maximization is where we're at. And why is that? Well, when we think of most for-profit businesses, broadly speaking, we're talking about entities that are owned by shareholders. And the overall strategic or corporate objective for most profit entities, of course, has to be shareholder wealth maximization. And one element of that is profit maximization. What does shareholder wealth maximization actually mean? Well, you're a shareholder, let's say, in a listed company. What are you looking for? You're looking for a dividend distribution, perhaps annually, and you're also looking for capital growth in the value of your shares. Now, without profit maximization in the business, there will be no dividend. So profit maximization internally for directors and managers is absolutely central. That's what they're there to do. So what are the ratios that they'll use? Well, the first one, I guess the big one in one sense, is the return on capital employed. Now we'll delve into that in some detail later on in this particular mind map video, but for our starting purposes, we're really talking about profit relative to the amount of funds that you've injected into this business. In other words, the amount of capital that you are using, formed in a percentage. That's a key area. More of that in a moment. What about return on sales or operating profit margin as a percentage of sales? Certainly that's important. Sometimes referred to as operating profit margin. You could also say it's linked to net profit margin. Note the terminology. Operating profit is just that. It's profits from operations. It's not net profit. When we think about a profit and loss account, right down at the bottom is the net profit. Net meaning after all deductions, all cost of sales expenses, all indirect administration expenses, all taxes, all interest, etc., etc. So this is slightly different. Operating profit margin, as we'll see from the percentage calculation, the formula, slightly different. What about gross profit margin? Again, an important ratio. We're talking about the relationship between the cost of sales and sales. In other words, you sell a product, you sell, in terms of revenue, $1 million per year. What you want to know is what's the profit margin on that 1 million? And by indication, what's the cost of sale? In other words, what does it cost you? Obviously, sales less cost of sales equals gross profit. More of that during this particular mind map. Now, briefly, let's go back to capital employed, because this area, within management accounting and indeed generally online, capital employed, the actual figure, can mean a couple of different things. I think for our purposes, the easiest way to deal with it, if we're asked to calculate capital employed, is just simply to take the total assets less current liabilities. But what you'll find online is that different observers and different qualifications tend to use different terminology, so it can get confusing for students. I would pick one, the one in the middle, total assets of the business, whether or not they're non-current assets or current assets, less current liabilities. That's the simplest way to get to capital employed for me. Outside of that, when we think about this next area of activity measures. Okay, what do we mean by that? Well, we're really talking about sort of, in one sense, efficiency, but really, in another sense, the sort of conversion, of items in the statement of financials into cash or sales. In other words, the degree to which you can move money, let's say, from inventory into your bank account cash. So several ratios are relevant there. The first one is asset turnover. Now, I'd emphasize this ratio because when we see the OT questions from past exams within MA, the examiner likes this ratio, and I don't think students do. It's easy to calculate in itself. I mean, look at the calculation. We're simply looking at total revenues divided by the capital employed, as we saw up top in terms of a definition. So the calculation is easy. That's not the hard part. The difficult part is that the MA examiner will mess around with the ratio. In other words, not provide you with certain information and ask you to do calculations, or perhaps link asset turnover with another ratio like ROCE. So star this. Be careful to understand what we mean. And indeed, let's look for questions within the OT section of the course on asset turnover. Broadly speaking, we're simply saying, well, okay, there's your turnover in the year. What's that relative to the amount of capital that you've employed to generate that turnover? Are you better this year than you were last year, or are you worse? Next area here is receivables collection period. Now again, this is important. What we mean by that is receivables are monies due from our customers. So you run a business, you offer credit sales to a variety of different customers, and at the end of each month or quarter or year, you have accounts receivable. You have monies owed to you. Now obviously, you would prefer those monies to be in your bank account, but you offer credit terms. Perhaps 14 days, perhaps 30 days, etc. So what this ratio does when it's calculated by taking the amount of the receivables divided by credit sales times 365 days, it shows you that that accounts receivable balance is relative to a number of days. In other words, it shows you your collection period on average for your credit sales, how long it takes for your customers to pay you on average. That's an important area because note, if the receivables collection period is getting higher and higher and higher, let's say quarter to quarter or year on year, what does that tell you? It tells you you're getting worse at collecting your money. If it's taking longer to collect money from your customers, your credit control department has an issue. We really don't want receivables collections periods to be increasing dramatically. A little bit, yes, but not dramatically. There may be reasons why receivables collection periods increases. Perhaps we're offering different terms or longer terms to a large new customer. Instead of 30 days, we're saying 60 days. So there could be reasons, but be careful. Broadly speaking, we want to have control over the collections period. We want to have good credit control. Next area is payables payment period. So really the reverse in one sense, if you will. The idea that we pay our accounts payable, our suppliers, for example, in a certain period of time. So really in this instance, what we're looking to do is obviously pay within their terms. I mean, suppliers will offer us 14 days, 30 days, possibly 60 days. Ideally, we pay within the terms. If we're not doing that, if our payables payment period is increasing rapidly, we know we're getting slower and slower and slower at paying our suppliers. Why? Is it that we have a cash flow problem? Perhaps this needs to be investigated. Outside of that, the inventory holding period. Now we know that inventory, broadly speaking, means raw materials, work in progress, finished goods. It could be a variety of things. We know it's a current asset. And in this particular case, the formula is quite straightforward. Inventory divided by cost of sales multiplied by 365. Now, holding inventory costs money. We have to house it somewhere. If we have millions and millions and millions of pounds worth of inventory, we need warehouses, we need storage areas. In addition to that, ideally, we should be turning our inventory into sales and therefore cash as quickly as possible. If the inventory holding period is rising, then that tells us something that needs to be investigated for sure. Moving from there, when we think about the relationship, now I mentioned this up top, this asset turnover area and indeed ROCE. Note that ROCE, if you look at the formulas up top, can be calculated in a slightly different way. If we take the return on sales, if we take asset turnover, and we basically use our mathematical ability, we can see we get to ROCE, which is basically profit before interest and tax divided by capital employed. So again, I'm just highlighting the use of this ratio, asset turnover. Be careful with that. Next area for us is liquidity and gearing. Let's deal with liquidity first. Now, from the study hub, you'll see that there's reference to this whole area of profit v cash flow. We know in business that without cash, it's very, very difficult to survive. You know, some observers would suggest that actually, yeah, you can have profits, but if you don't have good cash flow, forget your profits. Imagine a business that is turning over $10 million a year, but doesn't get paid quickly or doesn't have a good credit control department. They will have poor cash flow. So this area of liquidity concerns this sort of adage I get that some people would suggest cash is king. Cash is king for businesses, and certainly in my experience of dealing with SMEs, the SMEs, or some of them certainly, that I've seen have problems with are the ones that have poor cash flow management. They may be profitable, but they've got poor cash flow management. We've got to be careful. These ratios help us. The first one, the current ratio, very, very simple to calculate. Just current assets divided by current liabilities. We know where they are in the statement of financial position. What's the importance of this ratio? Well, think about it. It says, really, with your current assets, this is your ability in the short term. Remember that current assets are 12 months or less. Accounts receivable, prepayments, other debtors, cash, etc., inventories. And current liabilities are 12 months or less. So it tells us, as mentioned, that this is your ability to meet your short-term obligations, i.e. your short-term current liabilities. Now, every business is different and every industry is different, but a general rule of thumb here is if you calculate a current ratio and it's around about 2 to 1, so your current assets are twice the value of your current liabilities, broadly speaking, that's okay. Now again, it varies from business to business, industry to industry. The flip side of that is, generally speaking, if you have a low current ratio, so let's say it's 0.9, you've got 0.9 on top, 1 on the bottom, that's a problem because that tells you that your ability to meet your obligations, your trade suppliers, your tax liabilities, your short-term debts in the next few months is limited. That is an issue. The next area is, again, simple because it's really just the current ratio excluding inventory. It's called the quick ratio, and quick for good reason, because think about it. When we think about current assets, as mentioned, accounts receivable, cash, prepayments, other debtors, all of those things generally, apart from inventory, can be turned quickly into cash. Inventory may take some time. It's probably, most likely, the slowest item to turn into cash. So what the asset test or quick ratio does, it gives us a mechanism to say, well, listen, based on our cash flow, we just don't have a feel. Let's say if we excluded inventory, Are we still covering our current liabilities? Well, no, we're not. That's a problem. So these two ratios are the same. One just excludes the value of inventory and maybe gives a little bit more heat to the sauce. Let's move from there to gearing. Now, gearing for our purposes effectively means leverage. Now, if you're not familiar with that term, we're really talking about the relationship between debt and equity. What do we mean by debt? We mean borrowings, bank borrowings, borrowings from venture capitalists, borrowings from anyone. What do we mean by equity? We mean the shareholder's interest in the business. So when we talk about the capital gearing ratio, you'll see we put debt divided by equity multiplied by 100%. Now, why do we do this? Why is it important? Because debt brings some issues with it. For example, it brings periodic payments. If you have a bank loan, you have to service or pay that bank loan every month, every quarter, perhaps annually. It also comes with interest. If you default, banks can push for foreclosure. They can liquidate you. So the more highly geared, in other words, the higher the percentage of the capital gearing ratio, the more risk is associated with that business because the more debt that business has. Now, there are pros and cons to debt. Debt is not, at the end of the day, a seriously bad thing that we should all avoid or that business should avoid, but we need to be aware of the implications and the difference between, let's say, equity or financing through equity and financing through debt. Moving from there, the flip side, I guess, and linked to gearing or indeed leverage is interest cover. Look at the formula. We're talking about just the operating profit divided by the finance costs. Now, what does that tell us? It tells us the number of times that the profit from our operations covers our interest charges or our finance costs. This is good information. Let's think about it. If we had an interest cover of 10 to 1, so our operating profit was 10 times our interest, we should feel pretty comfortable because it would have to move significantly for us to be worried about being able to cover our finance costs. Really, the higher the interest cover, the more comfortable we are because the more times we can cover any interest on loans to banks, VC, etc. The next area for us is resource utilization. And again, fairly straightforward. We're really looking at, in one sense, efficiency, although that's the first ratio, is efficiency across the board. Let me explain. Let's take efficiency ratio in itself. Let's just say that we're producing a particular output in some way. We know, let's say, as a manufacturing entity, the expected hours. We know that it takes normally 10 hours to make that actual output. But we also know that the actual hours taken could be different. So literally, let's take expected divided by actual and multiply by 100%. That's going to tell us how efficient we are. We may be very, very efficient. We may take less actual hours. We may take more actual hours, etc., etc. So that's the efficiency ratio, very, very straightforward. Capacity ratio linked in one way, as you would expect. Let's say, again, we're talking about a manufacturing business. We know that we have a capacity within the business. Let's say we have 100 staff. We've got, let's say, 10,000 hours for a particular period. We know the budgeted hours, but we also know the actual hours that we've taken, let's say, for a given output. If we divide actual hours by hours budget, we get our capacity, the utilization of our capacity. In other words, this is what we could have done. This is what we actually have done. What about the next one, production volume? Let me just move the mind map down a little bit for you. So here, again, linked to what we said up top, we're talking about the expected hours to make an actual output versus budgeted hours. Okay, so similar to the efficiency in one way. So let's make sure that we practice the questions. For me, we don't need to be experts on resource utilization, but we do need to remember these ratios and be able to use them quickly to show how efficiently a business is using resources. Okay? So that concludes chapter 25. I hope you found that helpful and your studies are going well. Let's remember that the learning, or the deep or real learning, takes place from the OT questions, as I keep reminding you. Let's not avoid them. Let's do as many as we can, and let's repeat the areas that we have difficulty on. Many thanks for listening.